Hey soldiers, Rocket Mortgage has introduced the 1% down mortgage. Now, is this thing the answer to affordability in a rising rate environment? Or is it an economic disaster just waiting to happen in the lives of the middle class? And could it affect the overall economy as a whole? Could we be looking at another housing crisis a la 2008 thanks to these mortgages? Guys, let's just jump right into it. You can now buy a home with just 1% down. Sounds too good to be true? Well, you know what they say. If it does sound too good to be true, it usually is. Now, Rocket Mortgage rather, they're the same operation, but of course, Rocket Money is the money management arm of the company. They have an app. We did a whole review on it. You need to check it out if you haven't already. Rocket Mortgage is another arm of that company. Them and actually, there are two companies out there offering this 1% down mortgage. Now, I know people are saying 1% down. Yeah, I can finally get into that house because these interest rates have been going up. And, you know, here's the chart of interest rates over the past few decades here. You can see that back in the 80s, they were much higher than they are now. But folk who are purchasing homes now don't want to hear that. They don't want to hear about the 80s. They want to hear about right now, especially when you see this almost non-existent stretch of interest rate stretch we went through a few years back, and now they're rising. So there's sticker shock for a lot of people. Affordability is becoming a real issue. And you're stuck between a rock and a hard place if you are renting, because, you know, rent inflation is a real thing. Those rents go up every year, right? So two of the nation's largest lenders are now removing the struggle many home buyers face in saving up for a down payment by offering loans that require just 1% down. Experts warn that might not be a good thing. Last month, the nation's largest home mortgage lender, United Wholesale Mortgage, announced it would begin offering loans requiring down payments of only 1% of the home's purchase price. The move was followed by fellow lender Rocket Mortgage, which announced this week the launch of a similar program called One Plus. Now, when they're saying this week, guys, remember, these products have been out for a couple of months now, okay? The Rocket Mortgage loan doesn't require borrowers to pay private mortgage insurance, or PMI. That's a type of insurance that traditionally kicks in when buyers have down payments of less than 20%. So you got 20% in the game, 20% skin in the game. Mortgage lenders feel a lot more confident in you being able to make those payments. PMI, something that they say, okay, we need a little insurance on this just in case this person defaults, because after all, they don't have as much skin in the game. So this private mortgage insurance usually amounts to 0.5% to 1.5 or 1.5% of the loan amount per year. And this is broken down into monthly installments. But with the Rocket Mortgage loan, it's not requiring borrowers to pay the insurance. Sounds kind of risky, right? The banks went through that crisis just a few months ago, and we saw banks fold up because there was an inordinate amount of uninsured deposits, okay? So, story for another day, but they are definitely increasing risk there. Both lenders will kick in an additional 2% of the home's sale price, so the borrower has at least 3% down total. United Wholesale, however, will only kick in up to $4,000 toward the extra equity borrowers receive. There is no limit to that 2% on the Rocket Mortgage side. The loans are also income restricted, geared toward lower and moderate income borrowers. Now, again, that class, that socioeconomic class, is more sensitive and susceptible to economic downturns. These are individuals who are more likely to have less savings and are more likely to be to bear the brunt of layoffs and lose a job. Okay. So again, we have another layer of risk here with focusing these loans on moderate income and lower income borrowers. But again, on the flip side of that argument is these individuals are stuck between that rock and a hard place, because if they sit in the rental situation, they're building absolutely no equity. All right. And the mortgage situation, if prosecuted correctly, would allow them to at some point realize equity in that property. And wouldn't that be great if you could, basically make your domicile work for you financially? You got to live somewhere, right? And if you can combine that with, you combine shelter with you prospering economically at some point in that game, then that is optimal. It's really a good way to expand home ownership for families that otherwise may not be able to get a hold of the American dream. Now, this is according to David Stevens. He's the CEO of Mountain Lake Consulting, and they provide services to the mortgage industry. He doesn't work with either of the companies, United or Rocket Mortgage, but he is intersecting with companies like that. So I would argue that he does have a vested interest in being a bit biased. Okay, let's just be honest. I'm not saying he's being dishonest, but we know where his bread is buttered. Okay, he goes on to say one unfortunate reality for home ownership is saving up for a down payment can be pretty tough. That's true. Oftentimes it ends up excluding families with more diverse backgrounds. Now, what he should have said is it excludes those of a certain socioeconomic level. All right. That's what we're talking about here. Nobody's lending you money based on who you're sleeping with, what color you are, or anything like that. So it's really not a diversity issue. It's an income and asset issue. How much do you have, okay, to bring in and put down on a home? The biggest problems people have right now, the biggest problem, this is him saying this, I'm just quoting, I know it's grammatically incorrect. The biggest problems people have right now is affordability. Also down payments. Yeah, absolutely. That's definitely the case. Now that's according to Adam Speck. He is the executive vice president of purchasing at Rocket Mortgage. This is something clients have been asking for. However, some have cautioned that these extremely low down payment loans could be risky for borrowers, especially those with limited savings. Why is that? Because home ownership is more expensive typically than renting. Now, we've been over this. A lot of people think they're going to be able to put their money somewhere for free. Okay. Wherever you put your money, there's going to be a cost associated with it. You can put it under your mattress. There's going to be the inflation cost associated with it and lost opportunity cost associated with that, because you didn't have it out there working and it was just subject to the full brunt of loss of value due to inflation. So wherever you put your money, there is going to be some cost associated with it. You put it in a house, yeah, you're going to have to maintain that property, especially if you want it to appreciate in line with the comparables that are in that area. All right. So that will behoove you when it comes time to sell or when it comes time to take some equity out of that home. And as home prices have begun falling in certain parts of the country, buyers who don't make larger down payments could find themselves owing more on their mortgages than their homes are worth in these areas. Making it easier for everybody to get a mortgage with only 1% is like putting candy in front of a baby, says mortgage lender Shmuel Shayowitz, president and chief lending officer at Approved Funding in River Edge, New Jersey. Goes on to say people who should not be buying homes will be encouraged and enabled to buy homes. Now, that is true. Everybody shouldn't be buying a home. Like everybody shouldn't be buying a Ferrari. Like me, I shouldn't be buying a Ferrari because I certainly can't afford it. All right. And I'd be spending a lot of time hiding it from the repo man if I went out here and finagled myself into a 1% Ferrari loan. All right. So that's definitely true that everybody's not ready for that. And one of the dangers of the 1% down loan is that you could attract people who are just not there yet. They don't have the savings. They don't have the stability of income. The average down payment was 13% in the first quarter of 2023. So compare and contrast that with 1%. Now they're asking people to have a 620 credit score for that Rocket Money loan. That's not terribly high. They are saying that they're doing, additional vetting of the borrowers to make sure that the debt to income is acceptable. But, these things can kind of get out of hand as we saw in 2008. It's also important to note that the Rocket companies, Rocket Money, Rocket Mortgage, they actually lost. They announced losses in quarterly earnings in the last quarterly report. In fact, they announced a net loss of $493 million in the fourth quarter on revenue of $481 million in total. So they lost more than they made in revenue. It was the firm's first quarterly loss since going public in August of 2020, back during the thick of a mortgage refinancing boom that was highly profitable for Rocket. For all of 2022, Rocket Company saw $700 million in net income profits. That result was well below the firm's $6 billion profit in 2021 and its monster $9.4 billion profit in 2022. And again, that's when the refis were out there during the, when the rates decreased, the whole pandemic thing was going strong. So Rocket Money, now I bring this up because, hey, they're going to do what they need to do, right, in order to, keep their business going. And we saw that a lot of businesses got in trouble with just that back during the early 2000s, running up into 2008 real estate crisis. So one of the things that they're saying is a backstop. Borrowers that want to qualify for this loan still need to have the 620 credit score, at least sufficient. And that's as of today, the 25th of July, 2023. Sufficient income. They don't say what that sufficient income is, but I'm sure if you apply for the loan, they'll tell you. And that's a figure that's going to be a variable based on the price of the home. So you need sufficient income. They're saying that they need a low enough debt to income ratio to be approved. For the United Wholesale Mortgage and the Rocket Mortgage loans, borrowers or buyers must have credit scores of at least 620 and cannot earn more than 80% of their area's median income. So again, they don't want these people to be, solid middle class or above. This is targeted toward low, middle, and low income. The latter means that the typical local family in a region earns $100,000, then the borrowers there can't make more than $80,000 a year to qualify for that loan. Now, you also must be in the market for a single family home. That's a Rocket One mortgage requirement. So they're not looking at condos for this as of right now, or townhomes. The buyer still has to qualify for whatever that monthly payment is, says mortgage consultant Stevens. And we know that monthly payment is going to be higher than if you came to the table with more money on the down payment. All right, let's have a discussion about the risk, more of the risk associated with this type of loan. Most first-time buyers don't realize just how expensive home ownership can be. There are big ticket items that eventually need replacing, such as a roof. Listen, we put a roof on this house a few years back, and it wasn't cheap, okay? We put a roof on, you're looking at single family home, okay? You're looking at somewhere in the neighborhood of, and there's so many variables, how many peaks you got and surface area and all that jazz. You're looking at somewhere in the neighborhood of $20,000 for a new roof, all right? And you got to have a roof, right? You can't set up buckets around the house to catch the rainwater. And some people, they just delay and delay. And you can drive through neighborhoods and you can see people who are delaying the purchase of a new roof because they got patches, and you can see the patches, okay? If they're these conical shaped roofs, okay? It's just like the row home that I grew up in, and it's flat. Only the police helicopter can see who really needs a new roof. But in most of these single family homes, you know exactly who needs a new roof and who's delaying it, okay? So that's a very expensive item. Are people prepared for that type of expense? Furnace, water heater, okay? They're less, but still not cheap, right? A new washing machine. So those are items that have a defined shelf life. Then there is the maintenance, such as having the gutters cleaned, the property landscape. Let me talk to you about landscaping a property. Now, we got acreage, okay, and most of it, well, about half of it is just wild, okay, but we need to keep up even though you can't see my house from the road, okay, I still drive up to it. I can't drive up and say, hey, man, that guy that lives there, he's a slob. I have to maintain the property. Now, I can do that in one of two ways, both of which will cost me. I can hire a landscaper to come in and do it, or I can do what I do, which is do it myself. That costs me because that's time consuming. All right. Now, why do I still do that? I find it therapeutic. And I find that it helps my peace of mind. So it does have a value, not monetary, but it has a value. But I noticed that a couple of my neighbors, way over there, they're older now. And they're saying, I'm not getting out there in that hot sun and doing that, Tyrone. You're crazy. But those are the things you need to consider. Oh, look at this nice, luscious green lawn and the trees. And well, that stuff grows like wild, okay? And it needs to be maintained. And there is a cost associated with that. There are also those unexpected expenses when something goes wrong without warning. Homes are a machine, after all. Machines always need some sort of upkeep. Homeowners who don't have much equity in their properties won't have anything to tap into to pay these expenses. And if they opted for one of these loans because they didn't have much in savings to begin with, they might not be able to cover the cost plus their mortgage. It's potentially enabling home buyers who should not be buying a house, said mortgage lender Shayowitz. The people who should be given mortgages with 1% down should be more highly qualified individuals with the income and the reserves to make their mortgage payments. And as we've seen, that's the exact opposite of what is being offered, because they're saying you can't make 100% of the income in your area. Okay. They're saying you can't, you gotta be, lower down on the socioeconomic scale, on the economic scale in order to qualify for this mortgage. Another concern is that as the housing market corrects and prices drop, in many parts of the country, home buyers who use small down payments could find themselves underwater on their loans. But that's not necessarily a problem in the era of accelerated housing cycles, says the National Association of Realtors, whose interests lie in homes transacting. Listen, if you're going to stay in a home for a long period of time, you're not thinking about selling. Okay, you're in the home. This is going to be the forever home. You've got solid income. Okay, solid meaning maybe you work for the government. All right, and they don't fire anybody, right? Do what you want at the government. They keep you around forever. or something really stable like that, which I don't think exists in corporate America. But in those events, okay, you're staying put and you got a damn stable source of income, this might be just the thing for you. And I say you're staying put because, homeowners who don't have much of their own money invested in their properties are more likely to walk away from them if there are problems, or the property value goes down, or if they lose a job, or a job changes location, all kinds of stuff like that. Now you can't sell it for what you owe on it because you came in with a 1% down mortgage. And then that would lead you to short sale or foreclosure. And that then would impact your credit negatively and put you further behind the 8 ball than when you purchased the house with the 1% mortgage. So guys, look, go ahead and hit subscribe. All right. If you like this content, hit subscribe, become a soldier of finance. I want you to hit that thumbs up if you have enjoyed this, if it's brought some sort of value to you. Now, what I also want you to do is I want you to watch this video. Okay. This shows you how the area where you buy a home is paramount. Do you know buildings in Baltimore City are selling for 70% less? We're going to tell you why. Choose wisely. All right, guys, I'll talk to you soon.